How's it going, everyone? This video is a follow-up to my most recent video on understanding liquidity. If you've not seen it, I would urge you to check it out before you come and watch this one, because in this one we're going to dive a lot deeper into how to use liquidity in our trading. Let's get to it. So how can we use liquidity in our trading? First, I'm going to do a very quick recap of what we've learned so far. Number one, liquidity acts as a magnet for price. Number two, liquidity is essentially resting orders in the marketplace. Number three, there are two types of liquidity: buy-side liquidity and sell-side liquidity. Number four, buy-side liquidity rests above swing highs or relative equal highs. Sell-side liquidity rests below swing lows or relative equal lows. The algorithm that delivers price is always hunting for liquidity. The algorithm hunts liquidity in order to pair orders in the marketplace. Stop hunts are used to pair smart money orders with orders from retail traders. Now, everything listed on this page we already covered in the previous video on understanding liquidity. All right, so I'm going to jump into this lesson with the understanding, or with the assumption, that everything I've mentioned here you already understand. But if you don't understand it, my recommendation to you is go back to that video, check it out, because I really took my time and broke down liquidity like you've never seen. So I'm going to link that video in the description. Be sure to check it out. It will give you the best foundation you need for what we're about to talk about today. Okay, so with that being said, let's jump into it. Now, in order for us to begin to use liquidity in our trading, we must make a shift in how we view the marketplace. We must transition from looking for patterns to trade to identifying which liquidity pools are likely to act as a magnet on price. Now, we've already established that all the market does, all the algorithm does, is seek and hunt for liquidity. All the algorithm does is pair orders in the marketplace. Liquidity acts as a magnet for price. If price is always being drawn to liquidity, we must constantly view the marketplace with the understanding of where liquidity rests and which liquidity pools are likely to act as a magnet for price. Okay? So what does this mean? It means we need to start to view the marketplace the way smart money views the marketplace. All smart money cares about is liquidity. When they're looking at the marketplace, when they're looking to enter a trade in the marketplace, all they're focused on is which liquidity pool is likely to be raided. Okay? Smart money views the market through the lens of liquidity. That's all they care about. Smart money traders buy or go long in a discount and sell in a premium. Now, what does this mean? It means smart money will always look to buy where sellers are offering to sell at a cheap price. That makes sense, right? If you want to buy something, you're always looking for the best discount. Okay, who is in the marketplace that's selling what you want to buy at the lowest price possible? And that's how smart money thinks. They're always looking to buy at a cheap price. Smart money is always looking to sell where buyers are offering to buy at a high price. Makes sense. If you're a seller and you're selling, obviously you want to find buyers that are willing to pay a premium for what you have to offer. And that's exactly how smart money views the marketplace as well. They're looking for buyers that are willing to buy at a premium, willing to buy at a high price. Why? Because they want to sell in a premium. Because they want to sell in a premium, they need to be able to identify buyers that are willing to buy in a premium. Okay, and because smart money wants to buy in a discount, they need to be able to find sellers that are willing to sell in a discount. Okay, in other words, smart money views the marketplace completely opposite to how most traders look at it. And the perspective of smart money is the perspective you must begin to adopt if you're going to be successful in trading. You need to view the marketplace through the lens of liquidity. So if smart money is looking for buyers to buy when they want to go short, where will they find buyers at a high price? When smart money wants to sell, they want to sell in a premium. So they need to find buyers that are willing to buy from them in a premium. Okay? In order to maximize their profits, they don't just have to find buyers. They have to find buyers that are willing to buy at a high price. They will find such buyers above swing highs. This is where smart money sells, and this is why price often takes out an old high before a significant drop lower. Now, we've already covered this in our previous video. We've already covered where buy side and sell side liquidity rests in the marketplace. Now, in the schematic on the right, you can see I've annotated where buy side liquidity rests above an old high, or in this case, relatively equal highs. What will be resting above those highs? Buy side liquidity, buy stops. In other words, buyers at a high price. Because there are buyers at a high price above those swing highs, the algorithm will take price above those relative equal highs, purge those buy stops, take out those buy stops, trigger those buy stops. Why? So that smart money can sell. Smart money can sell to those buyers that are willing to buy at a high price. And once that order pairing is done between these buyers at a high price and smart money that wants to go long, that wants to go short, then the price turns and drops. So smart money knows that above these highs, they're going to find buyers at a high price, buyers that are willing to buy in a premium. And that's how come you often get stopped out. You get stopped out because more than likely you placed your protective buy stop order above these highs when you went short. The smart money knowing that, and the algorithm knowing that, they would hunt that liquidity, take it out, pair your buy stop order with their sell order, and then the algorithm takes price lower. This is the reason for stop hunts. This is the reason why price would often take you out, reverse, and then go in the direction that you thought it was going to go. Where does smart money find sellers at a low price? So in this case, smart money wants to go long. All right. Smart money will look for sellers when they want to go long. But in order to maximize their profits, they have to not just find sellers. They have to find sellers that are willing to sell at a low price. They have to find sellers that are willing to sell in a discount. If you want to buy something, you want to buy from someone that is willing to give you a discount, right? Same thing with smart money. They want to find sellers that are willing to sell at a discount, at a low price. Where will they find such sellers? Below swing lows, sell side liquidity. This is where smart money buys. Smart money buys below swing lows. Smart money buys below swing lows. Why? Because that's where sell side liquidity rests. When smart money is looking to buy, they will be looking to pair their long with sellers that are willing to sell to them. This is why price often takes out an old low before a significant rally higher. Again, maybe you want to go long and you went long and you put your protective sell stop order below this low, because that's what the book say. Put your protective stop loss order below a swing low. Smart money takes out that swing low. Sorry, the algorithm takes out that swing low, pairing smart money's orders with your sell stop, and then price is able to rally higher. So it's important for you to internalize price delivery this way. It's important for you to view the marketplace with the understanding of where liquidity rests and what the algorithm is likely to do in order to take price in an intended direction. Okay? If price is going to rally, more than likely we're going to see a purge of sell stops before the rally. So as a smart money trader, you would anticipate this drop below sell side liquidity. And just as smart money is going long, you would go long as well. So your view and your internalization and your perspective of the marketplace always needs to be through the lens of liquidity. Where does liquidity lie? Where are buy stops resting? Where are sell stops resting? All right. Now, there are two ways we can use liquidity in our trading. We can use liquidity as an entry trigger or as a profit target. Now, you want to use both. Okay, you want to do both. You don't want to just use liquidity as an entry trigger or use liquidity as a profit target. All right, using liquidity as an entry trigger means you identify and use a liquidity pool being purged as your entry signal to go long or go short. Using liquidity as a profit target is when you identify and use a liquidity pool as your target for exiting your position. So those are the two ways liquidity can be used: as an entry trigger or as a profit target. All right. Now let's look at some examples on how to do this. Two examples. Now I want you to study this chart. All right. Study this chart. And I'm going to walk you through the delivery of price. Okay. Take a screenshot of this and study it. Study it very, very closely. What do we have here? We have relative equal lows, all right? Price dropped, rallied, then dropped again, then rallied. What is retail going to be seeing this as? They're going to be seeing this as support. So they're going to be thinking that when price comes back down to this level, to this area, we're going to see another rally higher. So anyone that is long is going to trust that this level is a level of support, and then they're going to do what? They're going to put their sell stop order below these relative equal lows and anticipate that when price drops, it'll hit that level and then rally away. But that's not how smart money thinks. Again, smart money thinks completely opposite to how most traders think. Smart money looks at this and knows that people have placed their protective sell stop orders below this. The algorithm looks at this and knows that people have placed their protective sell stop orders below this. So what happens? Price rallies and drops and breaks this level, clearing all the sell side liquidity below this low. What does that do? This allows smart money to go long. Once this liquidity pool is attacked, smart money is able to buy from the sellers that are below this at a low price. So I wrote here, you would anticipate smart money using the purging of this sell side liquidity pool as a reason to go long, pairing their long orders with sell side liquidity below here, and you will do same. In other words, this would be an entry trigger for you. Now above here we have a swing high. What's going to be resting above there? Buy stops, buy side liquidity, or buyers at a high price. What would you do? You would anticipate that the algorithm that delivers price would need to pair smart money's longs. Smart money went long below here. But the algorithm that delivers price would need to pair smart money's longs with buy side liquidity above here in order to exit those longs, and you would do same as well. In other words, you would use this high as a profit target. So smart money goes long here, so they are long. Now when smart money is long, How do they reverse their long position? If you've watched the previous video, we mentioned in order to reverse a buy position, you need to sell. Okay, you need to sell. Now, if smart money is going to sell, they need to find buyers that are willing to buy from them at a high price. If they're going to sell their position in order to reverse it, they need to sell it to buyers that are willing to buy at a premium. Why do they need to be willing to buy at a premium? Because in order for smart money to make money from these longs, they need to exit it when it has risen into a premium. So price rallies into a premium. Smart money exits here. Why? Because they were able to sell to the buyers above this swing high. Now, again, if you're new, a lot of what I'm saying is probably going over your head. Like I mentioned in the previous video, watch this video a few times. And the idea and the essence is for you to go into the charts and study this on your own. Don't just use what I'm showing you here. All right, because someone might be thinking this is cherry pick, this is hindsight. Please go into your charts and study this. This is something that, I learned from ICT, and I went into the charts. I studied this myself, and I'm still studying it, and I'm amazed day in, day out. I see the same logic playing out again and again and again. All right. The last example. Again, I want you to screenshot this chart. Screenshot it, study it, keep it, study the price delivery, and then I'm going to walk you through the narrative. Okay, so what do we have here? We have relative equal highs here. We have a swing high here, a swing high here, another swing high here. What's going to be resting above here? Buy side liquidity or buyers at a high price. So what's the narrative? The narrative is this. Smart money wants to go short. But in order to do that, the algorithm needs to find willing buyers that smart money can sell to. Remember, in the previous video I said, every order in the market, every sell order in the market needs to be matched with a corresponding buy order. Okay? So in order for smart money to go short, the algorithm needs to find willing buyers that smart money can sell to. So the algorithm triggers the buy stops above these swing highs, allowing smart money to sell. This is where you would go short as well. Remember, anyone that has seen this sees this as what? Resistance. So they would anticipate that price would rally. Price rallied here, came down, rallied here, came down, rallied here, came down. So they'll see this as resistance. So they would anticipate that price would rally again, hit this level, and then drop. But that's not how smart money thinks. Again, I'm showing you how smart money interprets price delivery. The way they think is the buy stops resting above here. So I want to go short, but I want to go short after we ran those buy stops. Once we ran those buy stops, smart money is going to be able to sell. All right, they're going to be able to sell to willing buyers at a high price. And then once they sell, what do? See this swing low here? What's resting there? Sell stops or sellers at a low price. So smart money has sold and price begins to drop. How do they exit their position? That's the narrative here. Now that smart money is short, in order for them to exit their positions, the algorithm needs to pair those shorts with sell side liquidity. Smart money sold, and in order to exit, they need to do what? They need to buy it back. But in order to buy, they need to find sellers to buy from. Where are they going to find sellers that they can buy from? Sellers that are willing to sell to them at a low price, below the swing low here. So the algorithm takes price to the sell side liquidity, allowing smart money to exit. And this is where you would exit as well. In other words, this is how you would use sell side liquidity as a profit target. So I showed you two examples. In this example, we have smart money going long. Once sell side liquidity is ran and exiting once buy side liquidity is hit. In the next example, I showed you smart money going short once buy side is traded above, and exiting once we hit a pool of sell side liquidity. This is basically how you would use liquidity in your trading. You would enter once a pool of liquidity has been raided, and you would look for opposing liquidity to exit your position, knowing that the algorithm is going to seek that opposing liquidity in order to enable smart money to exit their positions. This is basically how smart money internalizes price delivery. This is how they view the marketplace. They're not viewing the marketplace in terms of patterns. They're not viewing the marketplace in terms of traditional support and resistance. No. All they care about is liquidity. And in order for them to be successful, they're constantly trying to understand which liquidity pool is in the crosshairs, which liquidity pool is likely to be raided next. And if you're going to be successful and you're going to trade with the big boys, you need to view the marketplace through the lens of liquidity as well. All right. So now your work comes in. All right. You're not going to learn how to use liquidity just by watching this video. It's not going to happen. You're going to learn how to use liquidity by going into the charts, studying the charts with the logic I've given you, trading with it in demo, using it over a period of time. That's how you're going to get good at using liquidity in your trading. So rewatch this video a few times. And once again, if you've not seen the previous video, I advise you and I urge you to check it out. It will lay the groundwork and lay the foundation for everything we discuss in this second video. And once you've done that, take notes, go into the charts and start to study it. And you would see that what I'm telling you about how price is delivered is the absolute truth. All right. So if you enjoyed this video, please consider subscribing to the channel. Please leave a like. It really helps this video to be discovered by other people. If you're a newbie trader and you found this video useful, I'm pretty sure there are other newbie traders like you out there that will find this video useful. Hitting that like button will help this video get discovered by those guys. So please be sure to smash that like button, drop a comment below. Let me know if you found this video valuable, and let me know what other videos you'd like me to make as well. Thank you for watching, and I'll catch you in the next one.